Ameya has been designated as a young global leader by the World Economic Forum. He is also a writer and author of The Rock Babas and Other Stories, published by Amazon and sold in over 40 countries globally. He is also the past president of the Indian Chamber of Commerce. NAFA Capital is an asset management headquartered in Mumbai, India, and manages funds in public equities, private equity, venture capital, debt capital markets that invest in Indian market.
Yeah.
Ameya is also a partner at UAP Advisors LLP. UAP's business include asset management, principal investing, investment banking, and sustainability in the agricultural space. I mean, the audience would like to know, what is an investment bank? Can you explain to our audience the similarity and difference in function of an investment bank and a merchant bank?
Sure, sure. Thank you, Mr. Roy Chaudhary, and it's a pleasure being back on the Indian Chamber of Commerce platform. I think it's a platform that I hold very close to my heart, and it feels really very. It's. They always say it's like batting on your home wicket. It's always the wicket which you can bat the best on. So very happy to be back on the ICC platform. I think firstly, what is an investment bank? I think if you look at the traditional definition of an investment bank, and especially in the US scenario, an investment bank, and I mean, I think you asked me the difference between an investment bank and a merchant bank. But what we'll do is first let's understand what an investment bank is. The investment banking business essentially is an intermediary between companies and those who want to raise capital. Now, there are different types of investment banks. You have the full service investment banks, which will do capital raising, IPOs, initial public offerings, private capital raising, debt capital raising, equity capital raising. If you expand that even further, you'll have banks who have underwriting capacity, which basically would mean that if you are raising capital, the bank would argument say you're raising $100 million, and the bank would actually underwrite those $100 million, saying they'll guarantee those $100 million and then sell it down to other investors. Other banks only do advisory, wherein they don't have underwriting capacity. They will say, if that's argument's sake, XYZ wants to raise $100 million, they'll act more as an intermediary between the investor and the entity that is raising it. Certain investment banks also do issuances. So, for example, you want to do a bond issue, you want to do an equity issue, you want to do an IPO issue. All of those are done by an investment bank. If you look at the broader definition of an investment bank, it also includes brokerages. So stockbroking can also come under an investment bank. Asset management can also come under an investment bank. But what I have just defined to you is the traditional American US definition of an investment bank. So say a Goldman Sachs, which will have all of this under them, a bank such as back in the day Lehman Brothers, which would have all of this under them. They'd also have desks within them which would do underwriting of bonds or trading of bonds. Now, this merchant bank is an Indian concept, or maybe a British concept as well, but an Indian concept. So in India, we divide the investment banking space into several different. So we'll have traditional advisory, which is what just basically acts as an intermediary between the companies which want to raise capital and the companies which are looking or are looking to invest. A merchant bank in an Indian context, and you mentioned that the disclosure norms as well as the minimum capitalization norms are a lot higher. A merchant bank are those who are allowed to actually underwrite and do IPOs, initial public offerings for companies. So that's, or for example, or even a QIP, qualified institutional placement for a company, or even any public market sort of transaction. So a merchant bank's disclosure norms are a lot higher, and that's the reason why they are higher. So SEBI, which is the Securities and Exchange Board of India, allows merchant banks to do public issuances both in equity and debt, and whereas investment banks which are not merchant banks, which are pure play advisory plays, can do more advisory, strategic advisory, also capital raise, which does not actually require a license. In India, asset management is a separate license. You have to do it under the AIF license, which is the Alternative Investment Fund, or the RIA license, which is a Registered Investment Advisor, or the PMS license, which allows you to do the asset management business. And again, if you want to be in the debt markets, you can be a debt market PMS or a debt market arranger, which you can do. You can also be brokerage, again, is a separate license. So in India, we have classified each activity and each business into their specific licenses. And of course, there will be banks, there will be institutions which will have all these licenses under one roof. But then, depending upon which license you have, you are essentially classified as that part of the investment banking business that is under you.
think in US, if somebody wants to start a company and if he wants to raise capital, they go to the capital market, isn't it? Whereas in India, we go to the banks to raise a loan to start a business. Am I correct?
Not necessarily. I think capital markets, you only go after you've hit a certain size. So
In
even if it's
US.
or any country, really. I mean, at the end of the day, even if you look at the US market, I think if you look at the classical journey of a business, right? The classical journey would be, first you put in your own money into a company. Then the first round, we call it the friends and family round, wherein you have friends and family invest in your company. Then you'll probably have a seed round, wherein potentially you'll go to a venture capital fund, or whether you'll go to an initial fund which would invest in your business. Now, if you're more of a traditional business, say you're setting up a car dealership, or say you're setting up more of a traditional manufacturing plant, this is the stage at which you would go to a bank in the US or in any other country in the world, wherein you'd go to a bank, wherein you'd go and get your first loan in order to make your capital investment or acquire your capital capacity. Now this is where your journey starts diverging. Now, if you are a tech company or a traditional startup company, you'll continue to do Series A, Series B, Series C, and then further rounds till you hit your initial public offering, which would be the end
Okay.
game of this capital raise. If you are more of a traditional company, now depending upon how cash generating you are, you would, of course, again, even today, venture debt is a very big thing. So a lot of startups also take debt, but IPOs come much, much later. So any country in the world, including in India, an IPO is probably the end game, wherein some initial investors will want to exit, and that's where you use to scale up. But whenever you set up a business, be it a traditional economy business or a new economy business, I think
Yeah.
it is primarily initially funded through investors, friends and family, and of course banks. Because, for example, if you are setting up a chemical manufacturing plant, not many VCs will be interested in that. I think the chemical manufacturing would end up being funded primarily through banks and maybe other private equity investors at the right stage.
Do
Yeah.
you deal with private investment in public equity and private equity both? And which is the more popular investment mode? You got me?
Yeah, I can hear you now. So no, I think yes, we do deal with both. So we primarily, as I said, invest in the Indian markets and both public and private. Our public equities business is a lot larger. It's almost 85% of our business compared to the private markets business, which is smaller. We currently manage between public and private about 2,300 crores, and almost 1,800 of that is about 1,800, 1,900 of that is public equities. So when it comes to our business, I would say public equities is a lot larger and more popular. And also, generally in India, public equities is a much larger and broader business than the private markets business that people are
Correct.
investing in. Though the private market business is growing, and increasingly people are investing in a wide variety of businesses on the private side. So people are investing in VC funds, angel funds. People are also investing in the private equity space. These are domestic investors. And if you look at the global private equity players, so global capital flowing into India, it is also quite substantive. I think that's, again, primarily, I would say, four verticals or four types of global capital.
How do you measure your networking ability?
Sure. I think networking, if you ask me, essentially, I look at it as I think one should look at how one builds relationships, because I think networking, according to me, is not a very positive connotation word with a lot of positive connotation. So I would actually look at it as how does one build relationships, because I feel relationships essentially should be trust based. I think relationships should be built based on mutual respect and trust built over a long period of time, wherein I think each partner, each participant in a relationship actually finds a net positive that comes out of that for themselves. Now, this would also mean if you look at and these are different types of relationships, right? These are business relationships, relationships you have with your colleagues, the relationships you have with people in your organization, because all of these relationships ultimately add a sum total to your career, to your business, to what you do. I think from that perspective, I have always believed that if you are good to people, if you help people in what they do, and you help people build a common ground, I think you can actually build very strong relationships. And I feel even when I was the president of the Indian Chamber of Commerce, we built a lot of strong relationships with stakeholders, both within India and globally. And I think we always ensured that these relationships that we build are actually adding a lot of value, not just to ICC, but also to all the people who are contributing or joining ICC, or engaging and aligning themselves with the ICC. And I think if you build a win-win in a relationship, these relationships always remain strong for you. These relationships always come through for you in the larger scheme of things. And I think that's what one has to look to build. And I feel that if that is the definition, then I would say yes. I think that I am good and at building, but also at maintaining the relationships over a longer period of time. So
Yeah.
I think from a again, when we say distribution ability, it's essentially the ability of an investment bank either to underwrite the capital that they're looking to raise, either debt or equity, and so that is very important, because the larger the underwriting capacity of a bank, the greater the ability of its ability to execute. And number two is, beyond underwriting, is you also don't want to keep too many of these assets on your balance sheet. It's the ability to go and get investors are who are biting, or who are believing in the story that you are trying to sell, which is essentially the security which you're trying to sell. Now, from an exit, I think the question, if I understand it correctly, it's about the exit from the investment that one is looking at. Now, exit is a multitude of several things. So, if you are, for example, bondholders in a company, depending on the liquidity of the bond markets, and if they are tradable bonds, you can exit quite easily. Similarly, if it's already a listed company and you're doing a QIP in that company, the ability to exit based on, of course, certain norms is again quite easy. But if these are private market investments which you are looking to exit from, I think that becomes a lot trickier. It also, for example, depends upon the liquidity of the instrument. So, for example, you could be a significant shareholder in a listed company, but if it's not so liquid, for you to exit the entire investment becomes quite tricky. Similarly, I think and again, in most cases, it is not the responsibility of the investment bank to provide an exit to the investor, because the investor has understood the risks that they are investing for. They've understood why they're investing in these assets, and basis that they are doing it. So I think you're right. Sorry, Distribution becomes very important from the perspective of an investment bank, but the liquidity post the conclusion of the transaction, that is essentially what the investor has to understand when they come into the scrip or into the bond. And I think that's a risk that they take, and if required, they price in that risk when they buy into the investment.
One last question, Ami, I would like to ask you. Specifically, the number of investors in a pipe deal increases by 41.9% if the deal is intermediated instead of being directly placed. Other things being equal, so people have money but not the knowledge, and they come to you for the same. How do you upgrade your knowledge?
I think, see, ultimately, if you are doing a pipe deal, it's highly unlikely that it will be done directly by the company. It will have to be done through a merchant banker. I mean, not highly unlikely, it cannot be done directly by a company. It would have to be intermediated by a merchant banker who has a license to do a pipe deal, which is essentially a preference allotment in a listed company. Now, so I hope I'm answering your question correctly, because you
Yeah.
mentioned about the increase in the number of investors. But I think, see, in any deal, it could be a pipe, it could be an IPO. If the number of investors who are subscribing to the deal is greater than the allotment that is available at that point in time, I think the allocation usually will be done proportionately. But I didn't quite understand in terms of increasing the how that fits in terms of increasing the knowledge of the deal. So, but I think basis what I mean from what you're asking, maybe if in terms of if I just maybe answer it in a different way.
And just
I think
last,
yeah,
I mean, just last
yeah,
one question which
yeah,
you can answer in 5 minutes.
yeah,
How do you manage networks in investment banking?
yeah.
How do you manage
So
networks in investment
I
banking?
think again, as I answered earlier, I think one should look at relationships, not networks. I think one should focus on building and creating solid, long-lasting
Listen,
relationships. And in order to do that, it has to be a win-win for every party that is involved. I think each and every party who is in a who is associated with you, who's a stakeholder in what you do, and who is a part of what you do has to benefit from that relationship tangibly or intangibly. Some people may not benefit tangibly, but they benefit intangibly in terms of knowledge, growth, network. So I think that's something that one has to do. And I think and again, you have to give it time. So even a relationship has to be nurtured like you nurture a plant. If you don't water a plant, if you don't give it fertilizer, if you don't give it the adequate sunlight, a plant will also wither away and die. Similarly, a relationship also needs nurturing. And that's I think a very important takeaway that I always had is that every relationship needs nurturing. Relationships that are given attention will grow. Relationships that we don't spend as much time on will not. So I think one has to build relationships and nurture them and ensure that it is every person in the relationship benefits from it. And I think if we do that, we will always ultimately be successful.
I think your knowledge and your experience is valuable, and I'm sure the viewers who are here with us and also who will be watching it will benefit immensely.
Sure.
And I think who else understands networking better than you? Because we have seen you building network, and ICC has definitely benefited from it because the networks which you developed, I think those are really working well, and that's how the chamber has grown and will continue to grow because of the networks which you had built during your term.
But I'm sure we'll get another turn chance to interact. And again, thank you, Dr. Singh, for arranging
Thank
this.
you so much. Thank you for your time, and thank you so
Thank you.
much.